Welcome back to All About Economics. In the last two episodes, we learned that smart investing means diversifying and judging performance against risk. But here is the catch for an ordinary person. Doing all of that yourself, buying dozens of different stocks and bonds, researching each one, sounds like a full-time job that requires a fortune to start. Investing can feel like an exclusive club with a very high cover charge. Today, we meet the tool that kicks that door wide open for everyone. The mutual fund. You will learn exactly what a fund is, why it solves the small investor's biggest problems, what it costs, and a clever trick used in Israel where a fund's risk level is hidden in plain sight, right inside its name. Let us level the playing field. Section 1. The small investor's problem. Picture this. You have worked hard and saved 10,000 shekels, and you want to put that money to work. But the moment you try to invest it yourself, you slam into two brutal roadblocks. First, the commissions. The fees a bank charges just to buy a single stock can be so high they eat up your potential profit before you have earned a single shekel. Trading in small amounts is punishingly expensive. Second, and even worse, with only 10,000 shekels you cannot possibly buy enough different things to diversify. Remember the golden rule, do not put all your eggs in one basket. But a small saver buying individual stocks is forced to hold just a handful, leaving them dangerously exposed to any one of them going bad. Section 2. The big idea, pooling. The mutual fund solves both problems at once with a single, elegant idea, pooling. A mutual fund gathers small amounts of money from thousands of ordinary savers, you, and people like you, into one giant collective pot. In Hebrew, it is called a keren, simply a fund. That pooled pot is now large enough to do what no individual saver could. It can be spread across dozens or even hundreds of different stocks and bonds, achieving instant, broad diversification. And because it trades in huge volumes, the per shekel cost of commissions shrinks to almost nothing. By joining their money together, 1,000 small investors gain the buying power and the diversification of one very large one. Section 3. What you actually own. So what do you own when you buy into a fund? You own units or shares of the fund itself, representing your slice of that whole diversified pot. If the fund holds 100 different stocks and bonds, then by owning one unit, you indirectly own a tiny piece of all 100 of them. When the value of the fund's holdings rises, the value of your unit rises in proportion, and when they fall, your unit falls. You are no longer betting on a single company. You are riding the combined performance of an entire, professionally chosen basket. This is the magic of the structure. A single, affordable purchase gives an ordinary person a genuinely diversified portfolio that used to be reserved for the wealthy. Section 4. The three big benefits. Let us name the three powerful advantages clearly. First, diversification, instant and built-in, spreading your risk across many holdings exactly as portfolio theory demands. Second, professional management. A fund is run by expert managers whose full-time job is to research, select, and adjust the holdings, so you do not have to. Third, accessibility. You can start with a small sum, the commissions are tiny, and the whole thing is designed to be simple enough for anyone to use. Together, these turn investing from an intimidating, expensive, full-time endeavor into something an ordinary person can do with a modest amount of money and very little effort. That is why the mutual fund became the standard way most people around the world, including in Israel, get started. Section 5. The cost, the management fee. Of course, none of this is free, and the cost is the management fee. Because professionals are running the fund, they charge an annual fee, a small percentage of the money you have invested, taken every year whether the fund goes up or down. It might sound tiny, perhaps 1 or 2% a year, but do not underestimate it. Over decades, thanks to compounding, even a 1% annual fee can quietly eat away a surprisingly large chunk of your final wealth. This is why savvy investors watch fees closely, and it is a major reason for the rise of low-cost index funds, which simply track a market index automatically, charging far lower fees than actively managed funds. The fee is the price of convenience, and it pays to keep it low. Section 6. Active versus passive. This brings us to a great divide in the fund world, active versus passive. An actively managed fund employs a manager who tries to beat the market by cleverly picking winners and charges a higher fee for that expertise. A passive or index fund makes no attempt to beat the market. It simply buys everything in an index, like the whole market, and rides along, charging a very low fee. Here is the uncomfortable truth that decades of data reveal. After fees, the majority of active managers fail to beat their simple index benchmark over the long run. Recall Jensen's alpha from the last episode. Genuine, persistent skill is rare, and you pay a high fee hunting for it. For many ordinary investors, the cheap, humble index fund is the smarter choice. The legendary investor Warren Buffett has said exactly this for years, repeatedly advising ordinary people to simply buy a low-cost index fund and hold it patiently for the long run. Section 7. The code in the name. Now a wonderfully practical trick specific to the Israeli market. If you have ever looked at investing in Israel, you have faced a wall of 3,000 to 4,000 different mutual funds. Overwhelming. But the most important clue is not buried in a 100-page document. It is sitting right there on the surface, in the fund's name. Every Israeli mutual fund carries a simple, standardized code baked into its name, an at-a-glance snapshot of its risk and strategy. The code has two parts. A number tells you the fund's exposure to stocks, its risky portion, with higher numbers meaning more stocks and more risk. And a letter or category tells you about the type of assets it focuses on. With this code, you can instantly read a fund's risk level without reading a word of fine print. Section 8. Choosing wisely. So how do you put it all together to choose? Start where episode 1 told you to, with yourself. Know your own risk tolerance. Then use the code, or the equivalent risk disclosure in your market, to find funds whose risk level matches you. A cautious, risk-averse saver should lean toward funds with low stock exposure, while someone young and risk-tolerant can accept a higher stock, higher risk fund for greater long-run growth. Then check the fee, because over time it matters enormously, and ask whether a low-cost index fund would serve you just as well as a pricier active one. With those 3 steps, match the risk to yourself, mind the fee, and consider indexing. An ordinary person can build a sensible, diversified portfolio with a single, affordable decision. Conclusion. We have opened the door to investing for everyone. The mutual fund solves the small saver's 2 great problems, crushing commissions and an inability to diversify, by pooling many people's money into one large, professionally managed, diversified pot, where you own units representing your slice. Its benefits are diversification, expert management, and accessibility. Its cost is the annual management fee that compounds over time, and the great choice is between active funds and cheap index funds, which usually win after fees. In Israel, a simple code in the fund's name reveals its risk at a glance, so you can match a fund to your own tolerance. Next, we move from funds to the assets inside them, starting with how to value a bond. If this made investing feel reachable, please subscribe to All About Economics and share it. See you there.